Hi, this is Michael Waitze, and welcome back to ATP. Trust is the foundation of all financial services. But what if we didn't need to explicitly trust institutions directly at all? What if investments could be managed in a fully decentralized, non-custodial, and AI-powered way, without traditional intermediaries? Can we use AI, blockchain, and smart contracts to create and manage tokenized investment products, offering a new way to potentially optimize returns while maintaining self-custody? Does Arna make decentralized finance more accessible for those accustomed to traditional wealth management? We are joined today by Srikumar Misra, the founder of Ara Protocol, to answer some of these questions and more. Sri, how are you doing today?
Very well, thank you, Michael, and thanks for having me on your podcast.
It is my complete pleasure. Let's jump right into this. What fundamental problem in investment and asset management are you solving with Ara Protocol?
Digital assets are a very different asset class, and they're probably, in my view, there are three types of digital assets that they are breaking into. One is Bitcoin, which deserves its own space in the entire asset class spectrum. If you see, it's the new gold, the store of value. Okay. Then there are native digital asset tokens, like what are commonly referred to as cryptocurrencies, or which are actually crypto tokens, and these have multifunctionality in various crypto projects and crypto companies, or they might just be serving a purpose, some cultural dimension, be a meme token, be an NFT, and stuff like that. So those are native token digital assets. And thirdly, the whole big world where tokenized assets, where traditional financial assets, real world assets, real estate, and stuff like that are getting tokenized and getting on chain for multiple reasons. So if you see the spectrum of digital assets, it really needs a different kind of asset management. You cannot copy paste the model of how TradFi assets, traditional financial assets, were being managed, because these are on chain. They reside on a blockchain. They are on a decentralized framework, and it needs really on-chain asset management to be able to make them accessible to a wide range of users and make them participate in this asset class in a much more easier form. So that's really the problem we're solving at Arna, to make to help users manage their entire digital assets life cycle.
Can we go through this in a little bit more detail, if you don't mind? So you mentioned real estate. You can trade real estate anywhere you want in the world, right? And every country has a real estate market. If you look at like Solana and Ethereum, you said other cryptocurrencies. Let's leave the meme coins aside for a second, because to me, those are purely speculative instruments at some level.
Yeah.
But if you look at Solana as like the euro, right, and Ethereum as the won or the yen, those things are managed off-chain as well. And gold, you can trade options on gold. You can trade, a bunch of stuff on gold if that's what Bitcoin is. Why do we need a different mechanism to trade digital gold or digital currencies or other digital speculative assets, including real estate? Like, just so people can understand why it needs to be different just because they're on a blockchain.
Right. Okay. So I think a couple of things. Firstly, you mentioned Ethereum and Solana. They are blockchains. They are networks on which other protocols are built, and so there's a whole emission of tokens. There's a whole token ecosystem that evolves from them. So I wouldn't say compare Ethereum to a particular currency. I would think of it as the entire financial, or in this case, it's a financial and computer network rail, which enables all decentralized finance, or for the matter, any kind of decentralized protocols, including decentralized computation or decentralized storage and stuff like that, to be built on it. Now, so given those blockchains, and given and real estate is probably the hardest example. It'll need a lot of though it's, why would you want to get other assets on chain? Let's answer that question in this framework. Is because it's very hard to to concepts like fractionalization and have been around for a while. Okay, where you could own a small piece of a large piece of asset. However, doing that at scale in a way which is accessible to everyone, freely movable and liquid. This is the first time perhaps where blockchain technology, crypto, is enabling fractionalization and easy liquidity flow via the tokenization of real world assets. Real estate is a difficult example. I think that's the sort of one of the last things that will get on chain, because all the legal framework and everything else contractually that is necessary. Okay, but if you look at all these other digital assets, they are complex. Their custody is different. Okay, they reside on a blockchain network, so they have to be managed differently. The way users hold them, for example, the way they custody them, the way they transact with them, the way, for example, and we'll get to that, structured products which are built on these native digital assets, which will ultimately make it easy and scalable for users to participate in. The way these structured products are built and accessed by users has to be completely on chain in a what we call a DeFi native architecture, in a decentralized finance native architecture, which makes it permissionless, in your self custody, without any counterparty risk, without any intermediary. So all of that is necessary for users to be able to access them in a very simplified way. Otherwise you will essentially have what has happened with ETFs. We saw the Bitcoin ETF, for example, or the Ethereum ETFs, which have been launched across many financial markets. You will need to have wrappers like that for every other digital asset product to be accessible through existing financial systems. So which is not an efficient way. It's a good way to get for users and investors to get started, access this asset class, but then ultimately to go beyond that, they'll need to get on chain.
Okay, so I want to go through this in the most simplistic way, right? Because I still don't think people understand why it needs to be, like, why this permissionless, why the trustless thing, like why this is necessary. And also the counterparty risk. Let's talk about a stock everybody knows and a company everybody knows and a company most people trust, which is Apple. Everybody has access to buying Apple. The settlement process is simple. You can buy it anywhere in the world. You don't need an ETF. You don't need a wrapper around it. Excuse me. And if the price gets too high, sometimes they split the stock. So again, the price can get lower so more people can have access to it. This is very simplistic. If Apple then gets put on chain, and the one thing I'll say is it's already digitally traded, right? Nobody's standing on a floor still and trading shares of Apple back and forth. And the counterparty risk that most people have is with the exchange, because they settle with an exchange. They don't settle with the person who sold it to them. In most cases, they have no idea who sold it to them, right? So if Apple is now on chain, how does it make it better for individual investors? Apple, in a way, is already kind of fractionalized, right? Because you can buy one share. In some cases, you can actually buy half shares, because plenty of firms have already gone out and built mechanisms to do that. How does the on-chain thing change it? And for the most simplistic asset, which is a stock, and everybody knows how that works, right?
Yes, I think that's a sort of a great question to dig in. And here's what. So, Michael, I think the first part is we take access for granted, and take the Apple stock. I'm sitting here in Singapore, and most developed markets, and have straight out access to buying an Apple stock if you had a few $100 or if you had a few $1 million. Okay, so everyone, it's democratized access, very simple. You go to many of the markets, take India for example, you cannot buy Apple stocks out there. Okay, so you need to go into a structure where
for regulatory reasons, do you mean?
For regulatory reasons, yeah.
So in India, if you're an Indian citizen, it's domiciled in India, you cannot trade stocks outside of India.
You cannot do that directly. You'll have to send money out through what's called a liberalized remittance scheme, or LRS, which has a limit, and then you'll have to have access to the vehicle to be able to invest in that. So all this is possible, but only at scale. So you could do only, I mean, typically these investments are only at $100,000 plus of a minimum ticket size. Okay, stuff like that. So, and I'm just giving you one example where I'm more familiar with, but there are multiple countries, and which means that multiple sort of hundreds of millions of people around the world are not able to participate in the tech growth of the world, for example, which they could have. Okay, so access is one big reason where which could have been fixed, which can be fixed once these assets are tokenized and are available freely in an ecosystem. Of course, there is still a regulatory issue around it, but the regulatory aspect can be sorted. But the ticket size, the accessibility, the sort of becomes much better in that sense. So I think access is still one of the major issues as far as which can be enabled on chain in a much more easier framework, and in a way which doesn't involve multiple intermediaries, which means costs and risk and stuff like that. That's the first point. Second part is that yes, it's obviously sort of from a risk perspective, in highly developed markets, financial markets, it's obviously there is no, in a real sense, no counterparty risk. There is a custodian who is sort of having custody of equity in this case. In crypto, it works. In fact, there is a higher risk as far as centralized crypto exchanges are concerned, because they're not only facilitating the exchange, but they're also having custody of the assets, which is a sort of conflicted in many ways.
I mean, we don't even. So think about this: the Nasdaq has never gone bankrupt, right? The New York Stock Exchange has never gone bankrupt. The TSE, so the Tokyo Stock Exchange, the Singapore Exchange has never gone bankrupt. But we could probably sit here for hours and talk about the number of crypto exchanges. I mean, all I have to say is 3 letters, right? FTX, and we don't have to talk about it anymore, about the counterparty risk. Sorry, go ahead.
Yeah, no, absolutely, and that's why the decentralized architecture for crypto is absolutely essential, where DeFi comes in. That's where decentralized exchanges or DEXs come in, which facilitate autonomous market making, for example. So then there is no intermediary who's having custody in that sense. Everything is on code through pools. But going back to the second point of how manipulation also happens in even in the most advanced markets. We saw not very far back what happened with the GameStop issue, for example. Okay, the whole fun around GameStop, and when genuine sort of supporters of GameStop were prevented from trading on Robinhood, right? And there was a marquee custodian sort of sitting behind Citadel over there facilitating the transaction. So all this, we know that financial markets as they exist are opaque, and many times, and it's happened in cycles of decades where something comes and blows up in the whole financial markets. Many times nothing reaches that blow up scale, but stuff is happening which is very opaque and impacts especially a lot of investors or users. All this, that risk becomes much more visible, and also in many cases that counterparty intermediary risk or manipulation that is possible becomes much more limited. I'm not for a matter saying that crypto or is currently free of that. In fact, it is rife with that.
It is rife with that. I mean, all I have to say is Melania coin or Dogecoin. I mean, these things are just completely right. I mean, there's so much fraud going on in those two things, and I don't want to attribute that to other people that are trying to do great stuff in Web3. I'm just trying to understand why we need, I understand tokenization. And look, I've been dealing with structured products since the early 90s. Okay. So, and I sat on and worked with options desks, structured product desks, swap desks, Quanto swap desks. So I've traded and been involved with people who have traded all of these products, and they scaled globally. I'm just wondering what is it about the blockchain itself, which frankly is slower? Like I can get instantaneous settlement on the TSE or under a picosecond, right, on the TSE, and still some of the blockchains out there take way too much time to settle stuff. That'll get faster, I understand that. But I'm just trying to understand, like, which part is it, the trustless part about it? Because the counterparty risk, I think, is not really an issue, because that's what exchanges are for. And real bona fide exchanges in the traditional finance world, they work. They never go bankrupt. And there's always a way to settle, right? And if somebody fails to deliver or fails to pay, like, there are ways to mitigate that and disintermediate that. What is it about the stuff that sits on the blockchain that's DeFi? And maybe we can talk about this idea of trustless, because I'm not sure I 100% understand that. And I'm sure the people that are listening don't. Why does it need to be trustless? I want to trust you when I interact with you. I trust the New York Stock Exchange, yeah?
Yes, again, so we're talking about the very foundations of the
Of DeFi,
technology,
yeah?
of DeFi, of crypto in many ways. But again, just before we get to trustless design, the example we touched upon and why the on-chain part of it and specific issues we touched upon were in the context of tokenized assets. So whenever you're taking an existing asset and putting it on chain, the fact is that the blockchain technology itself, as I said, there are three parts to it, right? So the first part is, I'd say, Bitcoin. The second is all native multifunctional utility tokens, okay, which are being emitted by crypto projects, which have incentivization attached to them, which solve a particular problem for protocols for the users. And I mean, there's things like, for example, decentralized computing, which again gets incentivized through tokens. For the matter, take what we're building as a DeFi asset management platform. The Ara Protocol token, the Ara token, will have clear functionality in terms of managing liquidity, securing liquidity on the ecosystem, stuff like that. So all this is currently over $1 trillion itself within the digital assets ecosystem, and this will grow multiple times as the use case of blockchain technology in a native form becomes much wider. So these native digital assets, they cannot be managed in any case in our existing asset management or exchanges or the whole financial system. So that itself needs an on-chain approach. Along with that, of course, the tokenized assets as they get on chain. So I just wanted to bring that distinction of that it's not only why an Apple stock needs to be on there, but it's the fact is that there are trillions of dollars of value is being created on native tokens as well, which also need to be managed directly on that. So I think that's the point. I think, and that's where I think the segue into trustless design becomes important. So what makes us think that trust cannot be broken or has not been broken multiple times in financial markets?
Well, I mean, again, CDOs, I mean, the trust in the financial markets. I'm not sure anybody trusts the financial markets, right?
Absolutely.
I worked at Morgan Stanley and Goldman Sachs for 20 years. To me, the whole thing looks like a fix, right? It just does. Anyway, I'm not disagreeing with you there.
So exactly. So there is we assume so essentially trust has to be a big part of making existing financial markets in the way they are structured to function. Okay, remove that trust, then everything crumbles. We have bank runs. There'll be liquidity runs, everything sort of dries up, right? So trust is such a big part of it. And time and again, we've seen that it has been compromised. Okay. And there is a dependency on trust. Now, if you can create a technology which enables financial transactions without having intermediaries who you need to trust, and that's who you need to place your trust in, without having the facades of big banks, like right behind me, there are all these skyscrapers of all the biggest banks in Singapore. They need to be like that for you to have the faith and trust in them, right? Can
you give me an example? Can you give me an example of an asset that doesn't exist yet? So, like, you want to tokenize something, and then you tokenize it, and then you give access to it to people that don't have access to it today, and then you take away the necessity for trust. and then show me how a few transactions take place in a way that intermediaries aren't necessary. Just go through that flow for me so I can understand like how it actually happens. The concepts I get, but like today, if I said to you, I want to do an IPO, right? And I'm going to use, Google did an IPO, I think it was in 2006 or 2007. They did it kind of in their own fancy way. They didn't go through like regular banks. They kind of managed it themselves. And on the day that it listed, everybody had access to it. You can still freely trade Google back and forth. There's been no scandal in the trading of the Google stock. There are rules against insider trading, right? That for the most part have worked. We'll see if that's true going forward. But that, like, I understand how that flow works. But I want to understand how it works for an asset, a tokenized asset that doesn't exist today, on something that can get tokenized, how people get access to buying it, how they know it's there, where they store it, how it gets custodied, and what happens if I want to short it? Who do I borrow it from? Do you know what I mean? I want to understand how all these little things work from scratch.
From scratch. Okay, that's the
I have plenty of time.
DeFi.
I have plenty of time. Yeah.
All right. Yeah. So let me also frame how we should answer that. So I think, Mike, you started with talking about an asset which is yet to be tokenized. Let's talk about something which is already there, let's say. Okay.
But I want to know how it gets tokenized. That's key though, right? In other words, how do I determine that like this asset needs to get tokenized? Let's say it's a case of whiskey. A lot of people, a lot of the platforms are trying to tokenize whiskey or tokenize art or tokenize, vintage wines or something like that. That's a big thing, right? Because it's easy and people understand it. How does it work?
So essentially, there is a representation of that has to be created on chain, and I'm going to sort of probably get lost in those terminology. It is the way it is getting tokenized in the sense is that asset is obviously getting held off chain under somebody's custody. There's a bunch of legal framework which comes into play, essentially lawyers and documentation in terms of managing, in terms of mapping that asset onto a smart contract. Okay.
Right.
So there is a smart contract. Now there is some legal documentation.
That's going to be Ethereum based, right? So a bunch of lawyers are going to get together and verify that this wine actually exists. They're going to have a technologist create a smart contract on Ethereum, and then they're going to expose that Ethereum smart contract to people so they can transact with it and say, I own a piece of that wine. Yeah.
Yes. Exactly. So let's say take a art portfolio of $100 million. Okay, and so that's custodied by someone or in a framework, and that's kind of mapped onto a smart contract. Now that smart contract issues tokens of a certain value, which represent a fraction of that ownership of that underlying asset. So now each of these tokens is mapped to that asset. Now it's gotten tokenized on chain. Now once it is on chain, there is no other intermediary you need to access that. You have your own in decentralized finance. You have your own wallet, the likes of MetaMask, and there are so many other wallets like that, which essentially is a front end, just a front end for you to reflect what you own. So you have your own, a public key and a private key, which is essentially like your account on the chain, and then you're able to go and onto either if there is an option for minting it directly from the blockchain. So for example, from the smart contract, for example, if I were to render certain services for that smart contract for that and be eligible to directly mint tokens from there, now those tokens are in my wallet, and I'm an owner of a part of that $100 million worth of art portfolio. Or I can go to what's called a DEX, a decentralized exchange, like Uniswap, for example, or for the matter, go to a centralized exchange like a Coinbase and buy these tokens of that art portfolio directly by paying on a decentralized exchange. It's directly from my wallet. I deploy stable coins or any other tokens and get in return in an atomic settlement, which directly transfers the tokens into my wallet. So now that's where the whole trustless design comes into play. I do not have to trust in a decentralized exchange anyone. It's the code which has taken my USDC or whichever stable coins and has given me in return the value of the tokens of that art portfolio that I've got. Now it's in my custody. It's completely liquid. I can send it to you. I can sell it to you through an exchange or whatever. So this is how tokenization of an off-chain asset at a very high level would occur. And then, like you said, what do I do with that? So now, let's say the art portfolio value is increasing, or for the matter, buyers and sellers of this token, which has this representation, see the underlying value increasing. So the token value kind of reflects that value in its kind of in its pricing. So now you've got that happening. Now, if you wanted to kind of now get into other forms, like you took the specific example of, let's say I wanted to short that. Okay. Now there are what are called perpetual dexes, essentially, which are derivative exchanges, futures exchanges, which allow you to go essentially have futures positions on multiple tokens. So now if these tokens are available there, you could potentially be shorting them, taking leverage, and doing all of this in a completely natively on-chain, where, for example, let's take this example. For example, you've got these tokens now of this art portfolio, or I've got them. You wanted to short them
because I think the world's going into a gigantic recession, let's say, and I think the value of art's going to go down. And I think specifically people that have bought a fractionalized piece of this, they don't have a lot of money, right? That's the whole point of fractionalization, is that you allow people that are not as wealthy as high net worth individuals get access to financial services products. But in most cases, they're not as knowledgeable or financially literate. So when things go badly, they're just going to start selling this stuff, yeah? Because that's the only money that they have, potentially. So I want to take a short position on it. How do I do that?
Yeah. Funny that you mentioned, we're talking about art. I don't know, just a couple of days back, I read somewhere, did you read that about art lending? Collateralized art lending. I think it's one of these. Yeah, it's one of these companies, probably backed by Sotheby's or some of these large art platforms, and they've actually for the first time called margin because the art portfolios
are getting killed,
gone down. Yeah, so they've called that. So how do you do that? So there are these dexes. So you essentially have let's call it our art token. So this art token, you can go and now take a short position on that, and you have, in the same transaction, you have the ability to obviously provide margin over there and take leverage on that. Now everything is managed on chain, so even if, let's say, it goes the other way and your margin is not enough, everything is settled by smart contracts directly. Your position gets liquidated, and obviously if depending upon the short that you've taken, if the targets are met, you're also their position is closed and automatically, and it's the value is in your wallet, back in your wallet. So everything happens on code. So this is all happening. In fact, it's the futures, the derivatives market in crypto compared to sort of the derivatives market in TradFi assets is much smaller as a ratio, and that is something.
It would have to be, because it's way less developed. Can I ask you this? I'm always concerned, again, because I sat on multiple trading desks, right? So I traded the most liquid stocks in the world. Like I literally once did a $700 million FX trade, yen to dollar. And the guys who did the trade for me just took a puff on their cigarette, took the other side of the trade, and then went back to having lunch. Like, it just didn't matter. It sounds like a large trade, but it's actually not. But if I did a $700 million trade in the blockchain right now, It's a gigantic trade, and I'll tell you why. Because in Bitcoin, well, in all of the coin markets, what is it, like $1 trillion market cap? Yeah.
No, so it's currently around close to 3 trillion, 2.5.
3 trillion. Fine, 3 trillion. But in the FX market, $6 or $7 trillion trades every day. So the market cap of the listed coins is actually tiny in relative terms, right? So how do you control for liquidity? My biggest fear with automated trading, right, is that the automated trading doesn't care about liquidity. So it's just going to keep hitting bids or keep lifting offers. How do you control for liquidity in this case, right? Because I've seen that happen in live markets where somebody's trading an automated portfolio and it just starts hitting bids or lifting offers, and it's a nightmare, right?
Absolutely. This is the biggest problem in digital assets. So there is a liquidity fragmentation. So there are multiple blockchains, and you've got the same asset. Let's take a particular token. It's kind of which is native to a blockchain. It's also residing in multiple, because everything is happening on chain. So there are multiple pools of paired tokens, for example, where transactions happen on multiple dexes. So the liquidity is completely fragmented. So that is a big problem in crypto currently. So unless we're able to access cross-chain, cross-protocol, even within Ethereum, for example, EVM liquidity from one protocol to the other is not seamless. So that is a challenge, and that issue leads to large slippage and price impact. Okay, so this is an issue. You cannot run a 700. I mean, obviously 700 is a that's the whole of one token. So it's a whole of one stock.
That's my point. That's my point.
So yeah, so you obviously we're talking, but even comparable sort of smaller trades have to be managed in the right way, so that price impact is limited. Now, there is another thing which happens in crypto, and this is the negative thing, and it's called MEV, maximum extractable value, so essentially, how do these settlements happen in this decentralized network? So let's say you and I are making an exchange. So we put that transaction goes onto a block, and there are these validators or miners who will approve that. Okay, so they are seeing those transactions. Okay, and depending upon what the fees that they will make, they will process that transaction. They'll validate that transaction. Now, because all of these transactions are on chain and the whole system is designed to be completely transparent, so a large transaction going into a block is now visible to these validators and others who are snooping on it as well, and you can essentially front run the transaction now. Okay, so and run a sandwich attack, and this happens regularly in crypto, and a lot of users don't realize that.
So front running is not a great word in the asset trading business, right?
Absolutely, and it's just, so for example, at Arna, when we structure our tokenization platform and running the transactions, we obviously faced this issue. We knew of it, but the extent of it was that we immediately had to intervene, and we upgraded our V2s, which contracts where all our transactions are run through private mempools, essentially. So they cannot be front run. At least they cannot be front run easily at all. So they are visible only after the transactions have been settled. So. Right. But yes, liquidity, price impact, slippage is a challenge in the space.
And how do we handle this, right? So everybody has their own wallet. Every chain has their own interface. And historically, these DeFi platforms for trading, because they're new, right? They've been newly developed. What's the right word? Like, the user interfaces have not been great, right? Yeah. And if you're trying to give access to people that don't have access to regular financial products, like if you look at the TradeFi trading products, I mean, they've just been developed for the last 30 years. So some of them are actually really, really good and really easy to use, right? How do you make the user experience for people better so that they can, I mean, we talked about a bunch of different issues, right? The liquidity and all these other things, but just the user experience, right? And this idea of everybody has their own wallet, but it's hard enough to explain, to your mom, how to use Netflix, How do you explain to them, like, don't lose your private key kind of thing? And if you do, all of your assets are gone because there's no way to get it back because nobody else knows it but you. Do you know what I mean? Like, how do you make this user experience easier and better?
Yes, I think, yeah, absolutely. I think that's again one of the bottlenecks in the space. How do you? I think there are two parts to it. The evolution of, I think, crypto blockchain happened in a way where, from the cyberpunks to a bunch of sort of folks who really believed in decentralization as a technology. So a lot of focus wasn't paid to the front end. It was all about the technology, the back end. So I think that has evolved a lot over time. For example, there are multiple protocols which are built on a deep tech stack within crypto, but their front end has become much more user friendly, even mobile first. And for example, even at Arna, where you can find the Arna DApp, the decentralized application, on in the iOS store, in the Android store as well. So and this is how it's kind of evolving, where the UI UX is being addressed. One part. The second part is at a more fundamental level. How do you make it easier for users to participate? And that's where concepts like account abstraction have come in. For example, you can have social login now. You can create a wallet where you're able to log in into the wallet with your Google account. Okay, and you don't the back end of the public and private keys is managed without you ever knowing that all that is happening in the back end, which is what we need to get to in a safe and secure way.
But that also means, again, that if someone gets your Google account passwords, then they can get access to all of your stuff, which is just like it is in the TradFi world. Yeah.
So exactly. So it's that whole trilemma. So if and here you've got this sort of dilemma of UX and security, and there is a trade-off for that. But at the same time, there are sort of in account abstraction for example, now apart from social login, there are other ways of recovering your private key as well, which is stored in a sharded way. So multiple things are happening, and I think especially with Ethereum, a lot of it had moved away from UX, and and now the community, the foundation, I think in the more recent past have really realized that what is needed to onboard the next hundreds of millions of people and capital on is really to make things easy, and that's where a lot of focus is going on. And how to make them easy is to encourage apps to be built on which essentially facilitate this for users to participate in decentralized finance, manage their not just their digital assets lifecycle, but sort of participate in a much more simpler way. So I think that stuff is beginning to happen, and has at least I've been in this space for just over 4 years, and I see a tremendous change over this time since then. Okay.
I want to ask you, because you said at the beginning, right, that Bitcoin is like gold, and I've wanted someone to explain this to me for a long time. Gold, you can actually like make jewelry out of. You can make earrings. Do you know what I mean? I can feel it. I can store it in Fort Knox. Like all this kind of stuff. It actually has intrinsic value that's unrelated to transactions or to a store of value. And to be fair, we went off the gold standard, at least in the United States, in the 1970s. Right, so over 50 years ago. So I think calling Bitcoin gold feels like a little bit of a misnomer. But if it is the gold of crypto, what's the intrinsic value that gives it value? And I was just thinking about this morning when I was on my run. Honestly, like at the end of the day, it only has value if somebody's willing to give you dollars for it.
Yeah.
And if that's the case, well, then you're connected to the Federal Reserve, and then you get back to all the same problems you have with inflation, deflation, money supply, money velocity, all these things that are supposed to be abstracted away from Bitcoin. So how is it gold?
Yes. Okay. Again, a sort of deep foundational sort of question. How is it gold? So firstly, I think we are using the word gold to reflect it as a store of value. If you look at the original Bitcoin white paper and what Satoshi meant it to be, it was originally a peer-to-peer payment system.
Right.
Okay, so
But nobody buys anything with Bitcoin. Nobody.
yes, so no, but it has moved on. That's why I said Bitcoin deserves a separate space in the digital assets, and it has moved on as a store of value. It's no longer a currency in that sense. Money having the attributes of money, but it has moved on to a store of value. And here, in this case, it's a value which can be completely audited. You don't know how much gold is there in Fort Knox, or for the matter.
I don't care because this doesn't mean anything. It's like how much gold the U.S. government has means nothing to me because nothing's based on it. So I don't care. There could be zero in there. It wouldn't matter to me, right?
So yes, but if you were, let's say, transacting with somebody where that had to be that was a base value, here you have something which can be verified on-chain directly. But I'm just giving a more trivial example of that. But I think the larger question is, what is now where is the store of value coming from? Even in gold, it's one big part of it's the supply and the scarcity of it, and the other part is the perception. Okay, so why, for example, our diamonds have been so valued when we know that it's now out in the open.
Because one family in the world named De Beers in South Africa controls the entire supply of diamonds. Diamonds themselves are neither scarce nor valuable. But
Absolutely,
go ahead.
Yeah. So it's more than that. It's also perception as well. So it's all of this kind of come together. So Bitcoin there is a finite supply. Okay, there is the monetary policy of Bitcoin is very clear. It's already coded into the Bitcoin network. So you cannot have more than 21 million Bitcoins, for example. So that's there. So the supply is finite. B, it is as a store of value. For you to hold it in your own custody. And there are sort of multiple ways of custodying it, either through a third party or directly, is much more simpler, easier than building a Fort Knox to keep gold. And individuals who want to sort of hold on to a form of a store of value, this is a much more direct and straightforward way. Thirdly, it's a great. Look at it's a complete. Why is it a store of value? It's a great inflation hedge. Every other asset. In the more recent past, gold has sort of outperformed Bitcoin. That's the only exception of gold itself. But every other asset class has kind of devalued, including the US dollar, which keeps the supply of it it's an endless, infinite supply in many ways, right? So in that sense, would I hold dollars or would I hold something like Bitcoin? So clearly there is value in Bitcoin, and moreover, it kind of makes it easier for me to hold it, move it around with me if I needed to. So there's a lot of other things in terms of where this sort of intrinsic value comes from.
Right, but if you want to, and again, I'll leave you with this, right, because I want to have a much longer conversation about this with you and maybe with a bunch of the other guys and gals that you have on your podcast. That would be great to get like 2 or 3 of you on the show and go on about this, because I think there's a lot to discuss. But I get the store of value thing, and I kind of get the inflation hedge thing. But let's say there's rampant inflation, but I want to still pay for my daughter's college, and a lot of my money is tied up in Bitcoin. I'm still going to have to sell Bitcoin into dollars to pay for Harvard.
Yeah.
Right?
Yes. Yeah.
So at some point, it's still related to what the dollar is, whether it's scarce or not, right? So it's a little bit confusing to me.
So yes, obviously, till you are paying everything in Bitcoin, which is not going to be the case. I think the world moved away from that. Any dollar-backed or the dollar or any dollar-backed sort of, let's say, stable coin or you will obviously need to convert into that to make that
to make any kind of
transaction. Payment, but you bought that when you got into that Bitcoin. You got into it at today, let's say $80,000 a Bitcoin. Right. when you are
unless you did it 3 weeks ago when it was at 103.
Yes, or unless you did it 3 months ago, for the matter, when it was a lot lower value. So it depends, right?
Yeah.
And I think the long-term trajectory for Bitcoin is definitely different. I mean, there will be these spikes, ups and downs. I think many of us believe that by the end of the last year, Bitcoin will hit that 100K. I think that catch-up happened very late in many ways. So when you exchange it later, instead of holding dollars and earning a risk-free rate of whatever, which is anyway eaten up by inflation, Bitcoin's value will continue to increase. So when hopefully we exchange it for when I exchange it for my daughter's, let's say, education, it will be a lot
Harvard,
better. Yeah.
Okay. So, look, let's do this. We've been at this for almost an hour. It's been a really fascinating conversation to me. We've covered a lot of really great topics. I want to let you go. Srikumar Misra, the founder of Ara Protocol, a lot to discuss, a lot to go over. And I would highly recommend you come back on, bring a couple of friends with you, and let's get a real vibrant back and forth discussion on where all this stuff is going. Because I think there's more to talk about. I really appreciate your time today.
No, thanks, Mike. Yeah, obviously there's this. It's a fascinating topic, and there is a lot of challenge to it. So as well, and a lot of things need to be fixed, which I think we're doing, and it's a long-term belief in how our financial systems needs to be fixed, and the decentralized finance is here to do it, but it's a journey.
Thank you.
Thank you.